So it's my real pleasure to announce our next keynote conversation, Sara Eisen and Steve Tananbaum. And what's really special is the connections I learned that each of them has to NYU. As many of you know, Sara is an NYU grad. She has been a big supporter of the initiative. Sara actually helped us launch the initiative with John Paulson in April of '24, which we're deeply appreciative of. And Steve Tananbaum as well, his father and grandmother, both took classes and went to the predecessor of Stern. So from our perspective, we're just thrilled to welcome you both back here. And if you can join us on stage, that would be great. Thank you. Let's welcome them.
Thank you. I swear I took a class in here, I think. Do you know what it was called before it was called Paulson Auditorium? No. Anyone know?
Ed, what was this building, what was this room called before?
Would there have been a biology class?
The auditorium. Someone gave us money.
Okay. Thank God for those credit investors, right? I'm thrilled to be back here at NYU, very special place to me. And I know for Steve,
yes,
multi-generational here, legacy at NYU. And really excited to be talking to a room full of people interested in credit, which I'm always amazed at how popular and how interesting credit is. Although I will say, Steve, the timing is perfect because credit's getting a lot of airtime these days on CNBC.
Boy, especially private credit.
Especially private credit. Is private credit in a crisis?
It certainly is in a PR crisis.
Is it only a PR crisis?
I think that, like many asset classes, and you could look whether it was private equity, when you have too much of a good thing, it stops being a good thing. And that's what's happened with private credit is and I look at private credit as just a different way to express debt. And so, these were smaller bond deals when I started in the market. Then they were second lien deals, and now they've been recategorized into private credit. And what was interesting to me is when the median private credit is 475 over, not that wide. So when you think of how you're going to make the returns, the only way to make the returns would be through leverage. So what started as probably 675, 775 got a lot tighter as more money went into the asset class. And we saw this in private equity a few years ago and seeing the results right now. The returns were lower as more money went in. Now, having said that, usually when you see bad headlines and low returns for an asset class, it's a good time to re-enter the asset class or certainly fill the void of what that asset class was doing. So I think that probably there's some pretty good deals for new software acquisitions, for secondary trading, and time will tell. But I think that's probably not a bad time if you have some fresh powder.
Does that mean that that's what you're doing?
We certainly are looking for it.
For opportunities on the credit side in software companies?
Yes, among others. So they didn't just finance software. So we did something in aerospace just this past week that we think was a good deal at a fair spread, kind of a loan to value of 50% we think it'll be a 12% return. So with a nice tailwind.
We just launched right into this. Sorry, I just did like CNBC style, like straight into the crisis. But really, I didn't intend to start that way. I wanted to step back and sort of help you introduce yourself and the amazing business that you have built at GoldenTree, which is now 26 years old. And when Dan Kamensky says that you're the GOAT, I mean, he knows everybody in credit. So that's a very big compliment, Steve. Talk a little bit about what the vision was for GoldenTree and what it is now.
So about 27 years ago, I saw that there was a need for more credit relative to other asset classes. I was in the equity department of Mackay Shields running their high yield business and their hedge fund business. And I'd see for growth managers, there'd be 400 managers in which 100 were top quartile and 100 very viable managers. Contrast that with credit. I was at the finals with just like 3 or 4 other managers. It was just like 4 or 5 of us. There was Oaktree, there was Shankman. There was just a few managers, and we'd be just a few of us going to every final. With the hedge fund, we grew to several hundred million in a couple of years, and I could tell that there was a lot of demand for that. So with that, I saw this opportunity that this area was going to explode. And with that, having a firm that was wholly owned by its partners, having several products, and having a firm that would be based on meritocracy. So if you do well, you're going to do well. We wanted to have the majority of our partners promoted from within. Leah Kruder, who's in the audience, NYU Stern grad, who runs pretty much half our business, he was promoted from within. Joined us as an analyst, as more than half of our partners have.
So do you think you manage differently than some of the other credit firms out there now?
So first, being wholly owned, yes, that's differentiating. The number, starting with several products, we started with 3 products in our first year. We were about $1 billion launch, which 26 years ago was pretty good size. We're not public.
How big are you now?
We're about $66 billion.
Pretty big.
Yeah, I think it's a good size. We are relevant, but we feel like we can still, we're not burdened by maybe too many assets given our strategies. And we also, still being not public, I think when you're public, you have a dual, objective, which is you want to grow your revenue, and then you want to have very good performance. When you're private, you could really just focus on the performance. So we're very focused on that.
And how has it been?
So all of our products are top quartile, if not decile. Pretty much throughout. We have about 10 different strategies, so we're very proud of that.
So what do returns look like?
It depends on different strategies. The hedge funds would be about 10% for 26 years. Our distressed funds would be in the upper teens. Our CLO equity strategies would be in the upper teens.
How do you do that?
That's a great question. So it's focus. We have a process. We also have a lot of passion for what we do. We talk about trying to always get better. One of the things, as you can imagine, when we started out, the market was smaller and we were smaller, and we've had to be broader and deeper to get the same type of opportunities. And so, we've been focused on how do we get broader and deeper? How do we know we always have to get better. The idea of the people who we started in the business, if you didn't learn different moves, different strategies, different asset classes, then you were pretty much left behind. Even something AI that's very topical with research and using as a resource, how to get the most out of AI. I see there is a book party for, I think, thinking machines here. And that's something that we're very much using and thinking about how does this improve and inform on what we do. And thinking about, we talk about each year trying to win a Super Bowl, and we know that the score is 0-0. So, or the one loss is 0-0. How do we put ourselves in a position to keep being in contention?
And AI is helping you do that?
It's certainly a resource. I'd say it's more in the in getting information quicker and helping complete the mosaic than I would say leading us to, hey, I didn't know this and AI helped us, opposed to, and we're not there yet, opposed to if research is a mosaic, it's certainly becoming a bigger piece of the mosaic as time goes on.
I guess what I'm really wondering is, are all these people going to have jobs?
Okay,
with AI
okay,
infiltrating every part of business?
Okay, the short answer is absolutely. Many of you will have jobs, and
That's not what we were going for.
Okay, well, and many of you will think of opportunities you didn't know existed, and so all of you should have jobs, and it's just you may not do exactly what you thought you were doing or setting out to do. And by the way, it was no different. I graduated college in '87. It's the same answer I'd give. So, the idea that we have somebody great and, hey, AI is able to do something that somebody great's doing, so we should eliminate the position's absurd. We're going to find something different for somebody great. I bet a lot of our peers are thinking about things the same way.
Like what? What does that mean for a credit firm? Like, what are you not hiring for, and what are you hiring for right now?
So I focus on the investment side, and on the investment side, we expect to grow. So we're not, on operations, outsourcing, processing trades. That's a trend that has always been to make more efficient and to outsource. So that's continuing to do that, and to the extent AI can help with that, sure. But on the research side, we are growing and expect AI to help us actually screen more efficiently. I remember when I got into the business, you had to just order the documents and do it manually. Then you were able to do with FactSet a bunch of screens. Now with AI, you can go to an AlphaSense and go, can you tell me, which is key to all the research? I'm looking at Microsoft. Tell me what the best analysts say the biggest opportunities and risk are, and please summarize. So that's something that's more efficient today than it was yesterday, but it's just a resource.
Yeah, I use it actually that same way when it comes to researching guests and topics on CNBC that we're talking about on a given day. So when it comes to thinking about AI and its transformational impact on business, how are you looking at it as far as the opportunity set when it comes to the investments you're making, or the risks that it presents on some of the investments you've made?
So there's certain times you want to catch and not pitch. And what I mean by that is we're understanding not what the hype is. Every Anthropic release is going to eliminate an industry. We're trying to understand what the impact is and how lasting, and is it complementary or destructive?
Yeah. I mean, we had ServiceNow CEO on today, Bill McDermott. He's pissed. I mean, because their stock goes down. It's come back a little bit, but, it's down 30%, and his results have never been better.
You look at something like EV and penetration. And there was a time, I'm going to say 3 or 4 years ago, where EVs, the penetration was going to continue to accelerate. It stalled somewhat. You look at programming with streaming. Even though it was unprofitable, that was going to be the preferred way, and then that also has changed its business model and its valuations. So it's developing, and I am reticent to draw any conclusions right now. One of the things that's interesting about software is, if you were like to use the example of EVs and OEMs are very capital intensive. So if the business slows down and it has very high fixed cost, then the economics of the business really come into are very challenged. Software is a cash generative business. Now it depends on the revenue model, and it doesn't require a lot of capital, and your retention is usually pretty high. So even if the retention is going lower, that's the repeat user of a software program, it should generate a decent amount of cash given different environments. So I do think that there's residual value in contrast to something like an OEM, which just may not be economic. So I do think the business models will be more interesting in a bunch of scenarios than maybe what the media is just assuming that they're going to go the way of the carriage industry.
Yeah, but it's not just that. I think it's we talk a lot about existential threat, but also just about the ability for these companies to have pricing. They've had this per seat pricing in the software business, and just how strong their moats are, right?
Yeah.
In a time where AI does allow some of these processes to be done cheaper and more efficiently.
Yeah. Well,
Is that fair?
I think like retailing, there's certain retailers who have, different moats than others. And it's hard to talk about software just generally,
Sure.
So I think that if it's more data intensive and requires individual attention and you can't have a mistake, then that's going to have a better moat than if it's more general. And so I think it really depends on the company.
Yeah. So some of the software sort of meltdown and questions about their viability in the future have, I think, spiraled into this private credit issue.
Absolutely.
So you said it's a PR crisis and there's some interesting opportunities, but what do you think is actually going on here, which is causing so much consternation?
Well, if I said it was just a PR crisis, I think returns will probably be disappointing relative to what expectations were a year ago. So if you invested a year ago, at least for the next 12 months, so the 24 months, a year ago, 12 months forward, probably will be disappointing relative to expectations, as an asset class. And that's the opportunity. That's, I think if you were to look at high yield as an asset class, historically, when you have valuations which started the year in the bottom third quartile, top fourth quartile on price and spread, that you historically, when growth expectations are good, 2% or better, you earn less than the coupon. And if growth expectations slow down, so your actual results, instead of being good growth of 2% plus or 1% or less, then you're negative. So entering the year in just high yield, you had a poor upside downside. And I think private credit, which tends to be riskier, is more exaggerated. So just as a neighborhood, I think it wasn't a great neighborhood to start with. Now, in terms of what was desirable in private credit is you got to have a lot of companies that had large valuations, which software did, but poor ratings. So a lot of the buyers of private credit and of software were looking at the transaction values of, and having comfort that that was your asset protection. A company was worth $1 billion, so it could have 250 of debt. Well, if it turned out that the company was only worth, call it $400 million, that 250 seems pretty aggressive. Now, one interesting thing on the software side is if you look at some of the public software companies that have issued debt, you can buy the first lien debt at approximately 25% of the transactions. So I was looking at some stats of some of the companies we have, and if we were to do a cross-section, you have about 300 million of EBITDA for the companies. There were probably at least $5 billion transactions. And you can buy the companies for about $1 billion to $1.25 billion. So they certainly are on sale. Whether it's justified or not, to me, it's provocative about what some of the value is.
Have you been involved, in the past few years on the private side, as some of these other public companies have, so that everyone's worried about now, Blue Owl and Ares and Apollo?
So we've done private credit for 26 years. So it wasn't like we just got involved.
Because you do multi-strat. You do private credit, you do public, right?
Yep. In fact, Equinox was one of our first private credit deals of the fitness centers. And I think that was 2001 or 2002. So giving them money to expand.
Was that a good deal?
Yeah.
Yeah.
It was
it's still around.
Yeah. I'm one of the few in that space that's still around after 26 years. So we tended to focus, though, not on the Equinoxes of the world, but looking for companies that, on average, were worth about $2 billion. So that tended to, so we feel pretty good about where we are in that, and avoided kind of some of the smaller companies.
And what's going on with some of these redemption requests? How do you think that plays out?
What I don't know is what the buyer was told about how this works. In other words, my guess is it's disappointing that they only can service 5%, but if it was communicated, hey, this is the risk when you buy, and these are retail products, that's the issue that I just don't know how it was explained.
Should they be retail products? HLN, BCred, all these?
I think so.
Yeah. Is that a good thing?
I think that there's the matching the opportunity with the supply of product. And I think it strikes me as if they became manufacturers. So what do I mean by that is as long as something would satisfy the criteria that they were looking for, let's just say a software company that's valued at $500 million that's looking for $200 million of credit, of debt, we're going to do it. And then if we do that enough times and we do it enough times in other industries, we're just going to reload, opposed to what's the quality and what's our, so I think the quality, my concern is as these funds got larger and larger, strayed. But I can only guess on that. That's what it seems like when you look at some of the cash coverage on some of these funds that's reported, which is somewhat precarious to the dividend, that the only way they could satisfy is by borrowing and using the PIK interest. So I don't know, Sarah, if you know what I'm referring to.
Nope.
So
I'm sure people in the room, though, do.
So the BDCs pay these dividends, and the dividends often are not covered by cash.
They borrow.
So they borrow on it. Now, the reported numbers, let's just say you have a dividend of, let's just say, $100 million, and you have interest income of 110. So you go, well, no, it's covered 1.1. Well, if it turns out that 30 million is payment in kind interest, then your cash interest coverage is below the 1-to-1. And many of the BDCs have cash interest coverage of less than 1-to-1.
Which is bad.
It's not ideal.
Yeah. So what happens? Do the dividends go away ultimately?
Well, they may have to, if it looks like the PIK interest is fictitious, they're going to have to lower the interest that they're paying, the dividends that
You think that's the next shoe that could drop?
It's certainly, that's what the market's predicting.
Yeah.
Without knowing these portfolios, it's hard for me to
Sure.
Pontificate, but that's clearly what the market's concerned about.
And then there are these new headlines like the big banks, like a JP Morgan is, for instance, coming out and restricting some lending
Yeah.
for these companies. What does that tell you?
That they want to be larger in private credit.
I think Jamie's been, jealous of private credit for a while, no?
It's certainly a part of the market that I think they wanted to do more in. Now, I generally think when he says it's overextended, I think he's commenting on what I just mentioned. So I think there are aspects of that, but I think they'd like to get larger in that space. It's been a good space, and their sourcing is very strong.
Right. Ultimately, does private credit as an industry get bigger after this, or do you think this is like some sort of wake-up call?
So overall, credit has always expanded, in my lifetime. So I would expect it's going to expand, whether it's expressed through private credit or broadly syndicated loans. It's just, I'm not sure the way it's going to be expressed. You look at structured products, was very big up into the financial crisis, and then really hasn't come back. But that isn't to say that people didn't find, that those borrowers just stopped borrowing. They just found different outlets to get credit.
So that's what could happen here. Why did you not take GoldenTree public ever, like some of the others?
Well, we really wanted to focus on performance, and we didn't want to be, have a dual focus on revenue. And we think it's a competitive advantage to be private and to be a private partnership.
But if you are driving performance, don't you drive revenue too?
We do, but it's not always, there are times where we don't, feel when there's less volatility, less a need to to raise money.
Got it. Yeah, that's probably nice.
Yeah.
So just one more on the private credit thing. Do you think it's at all systemic, what's happening?
I think it's cyclical.
Like a larger risk to the system? No.
To have a bad distress cycle, you need a bad economy. And when you have a bad economy, there are a lot of contributing factors. So for something to be systemic, there needs to be a bad economy. If it's just on its own, let's just say it's isolated to disintermediation in software, I'm not terribly concerned on that. Yeah, will there be banks that need to raise money or funds that had very poor performance? Sure, but I wouldn't expect that to be broadly problematic to the economy.
What about this? We have these rising oil prices and gas prices, the war in Iran, some jitters around that as well, coming at the same time. Does that make you question the cycle?
Well, you have to be oblivious to not, wonder what scenarios are priced in. I think that what we've seen, and I know the market's turned on the ride down here to be more negative. I think that the market is grappling with the timing, and then what does it mean for the economy, and then the future. And I think that it's still sorting it out. I remember. I think that the market is still trying to figure out the ramifications of higher for longer when it comes to oil prices and this war. And I think it wasn't necessarily priced in a few days ago. I think it's certainly entering people's radar screen. And then what does that mean? In terms of are people taking their forecast down? Not yet, but my guess is if this lasts for a few months, they will.
What is your economic outlook at this point?
So it's hard to put a lot of faith in it, given that you just don't know how long this war is going to be, and what's going to happen with the passage of oil.
Yeah, but before this,
it was subdued inflation in the mid 2s, growth around 3, so nominal in the mid 5s.
That's good.
Yeah, and we thought the biggest risk was the balance between growth and inflation. So if you had more real growth, good for the markets. If you had more equal inflation, bad for the markets.
Yeah, and then that raises a question of what the Fed's going to do here. Do you have a strong view?
Listen, I think Kevin's a terrific choice.
You know Kevin.
I do, yeah.
This is like insider information here on Kevin Warsh, right? Because he worked for your firm until...
Well, he was an
advisor
to our firm for many years. Listen, I think he's uber talented, very pragmatic, and I think he's a great choice.
Well, okay, so does that mean he's going to lower interest rates at a time where oil and maybe inflation is elevated because the president wants him to?
It's like asking me if the Yankees are going to win 95 games. It's really tough. It's really tough. You tell me where oil is. You tell me. I think it would have been an easier question without some of these external factors. And I think that he can help but catch, not pitch, relative to what the environment is.
He's always been hawkish, interestingly. In his public statements since the financial crisis.
Privately, not so much. And I'm going to say for years, even when, let's just say before
Trump started pushing.
I'd say before Trump was elected, he was pretty pragmatic. And, he has a very good sense for the markets, the players, and how things should unfold.
And believes in Fed independence.
Yeah.
He said that.
Although it is one of these things where when you have Greenspan sitting with, I guess, on State of the Union with I think Hillary and her family, you just wonder, there's always been a relationship there. So I think I found Powell somewhat political.
You did?
I didn't find it. Yeah.
Wait, why?
I found it surprising that he didn't raise rates earlier until he was confirmed for a second term, and then raised it pretty pretty quickly, where it was obvious to me that he should have raised it before.
Yeah, he thought it was transitory, the inflation spike.
That's the statement, but I found the evidence pretty overwhelming. It wasn't. But that's, but I would put, not to single him out, I just think that it's not a separation of church and state that's absolute, broadly speaking, which is kind of, I think your questions were kind of an absolute question, and I was trying to say I think there are gradations.
Yeah, no, I mean, look, that at the end of the day, it's an appointee by a president, right?
Yeah.
And their oversight is by Congress, so there are politics involved there.
Absolutely.
So are there investment implications from a new Fed Chair Warsh?
I think the macro environment will really dominate. I don't think that, that's what I'd be looking at first. Do I think he's competent? And maybe to turn it around, if I felt there was an incompetent Fed chair, would that be problematic? Yes. But in terms of, broadly speaking, on the competence of the last few, I think it's really going to be the macro environment that's going to be the most important variable on those issues.
What was his work like at GoldenTree? What did
He would just
you guys do?
he would just give us his state of play in the world. Would go around the globe and tell us what he thinks is happening.
Was he right?
He was more right than wrong.
That's better than most economists, I would
Absolutely.
say. Right? What about the relationship right now with
He was also a good listener.
Okay.
Which I think is a good quality that I always appreciated with Kevin.
what do you think it'll mean as Fed Chair?
I think anybody who's a good listener, that's a great trait to have.
Agree. As good leaders. I see that across corporate America too. I was going to ask about the relationship between credit and equities.
So, you asked my thoughts about how credit was going to do in this current environment. Usually on the current environment, if the economy does well, equities do much better. And so that's still the case. I still think equities will do better than debt. And if you look at certain industries, you look at something like take MGM. So Caesars is in play. And MGM could get financed in the credit markets. Its market cap at, call it 36, very easily. So you look at Comcast, which is too big to be LBO'd, but at its current market cap, also could get financed at its current statistics, not its market cap, it's too big, with $10 billion of, actually it has more than $10 billion. Thinking of its free cash flow is, I think, 10 or 11 billion. So its EBITDA is, probably a multiple of that. But it's, you look at some of those companies and how they're valued. You look at something like Kinova, that's a pharmaceutical, that also could be in the debt markets 100% financed. So I'm seeing the relationship between what the debt markets are willing to finance and then what and how companies are valued in the equity markets as really skewed towards equity. And you look at something like, I mentioned not all relationships. You look at something like credit and software. It's now trading at about a 75% discount to where some of these they used to trade, and probably even to where you're creating the fastest growing companies that have stayed public. But certainly companies with good stats and good growth, you can create at a pretty good discount in the credit markets. That's one area where I think the credit markets is discounted maybe more than the equity markets.
So better opportunities there, which is why you keep coming back to this opportunity in software.
I'll tell you one other thing is if you look at industries that have been dislocated, whether it was housing in 2008, media and technology in 2000, energy in the mid-teens, software, which is widened by about 350 basis points, still has 350 basis points to go. So if you look at prior industries and where they've how wide they got.
We're not at the bottom.
Yeah, we're not at the bottom yet. So to give that also as a balancing, statement about the opportunities.
But so then, how do you think about timing? You want to be timed well or right?
I'd rather be right than time will. I mean, you're right, and particularly when you're a decent-sized firm such as ourselves, you have to pick. You may be uber clever and be right for the timing, and you just didn't get any. So you have to kind of balance the two.
Does credit still lead equities? I mean, I always looked at credit as a leading indicator for stocks, for the economy, but it's been so benign.
You'd be surprised how many times the equity markets signal that something isn't right, and the credit market doesn't care until it does. And it's always something I've been surprised about. But I think in general, the better analysts are on the equity markets, not on the debt markets. So when I think of who knows the situations in the industry the best, it's broadly speaking the equity side.
Maybe because of the access they get with the companies?
I think it's, being the junior part of the capital structure, there's more to lose and more to make.
Mm-hmm. So are there any signals in the credit market that are worrisome or wobbly?
You certainly have, in this environment with the war, there's certainly been, on the riskier credits, it's just been, they've been softer and less liquid. But you would expect that given the current situation. I would have said for Liberation Day the same thing.
Yeah. What about distress? Like, are we going to see a true distress cycle again? When?
To have a distress cycle, you need a bad economy. But you always have industries that are out of favor and that go through issues. And it looks like the one that's in that people are predicting is software.
Yeah. You're really into software right now. I want to open it up, I think, to our great audience here for questions for Steve.
Great.
I'm happy to keep going, but yes, please.
What's your exposure to data centers and the hyperscalers?
Very little. If I were to cup it, I'd say maybe 1%. And probably if I were to go the over-under, probably under. We just had them. I'm excluding the XAI, which part of it was just guaranteed by the parent company, SpaceX. And maybe even with that, it's 1%. So, and that's the only one that I think it's still on the come. It could work terrific. It could not work. I think there are the issues of the counterparty risk. And the counterparty risk, probably the easiest deals are investment grade, where the counterparty risk is investment grade, and those just don't necessarily have the returns we look for at this point. OpenAI could be fabulously successful or not. And then you also have the chip issue of what's the residual risk. Is it 5%? Are the chips worth 5% or 15%? And that's really important to how these deals are structured.
And are you actively fundraising now?
We, are always on something. So I would say, we have 10 different products. So, some are closed, many are closed, and some are open.
Which strategy is doing the best right now?
You know what? As of yesterday, they're all like up 0.5%. I'd say across the board. So it's pretty much,
A tie.
Yeah.
Yes, we have one here.
Hi, Aisha Kelsey with DebtWire. So I write about software every single day.
Okay.
And you said 350 basis points more to go on the downside. How are you looking at software companies right now? Because when we saw everything trade down, it's from like an auto software company to maybe new services, so everything in here. And what's kind of your focus in terms of, is that margins? Is it subscriber businesses being less in favor?
Sure.
Or?
So a couple things. First is, if you look statistically, it could be statistically 350 basis points is where other industries have gone to. If you look at the median, some have gone much wider, some have gone less. But if you did the median, it was another 350. I think Sara asked me, what am I doing? And we're certainly are nibbling at some. So there's certainly some that we find are interesting.
Like what? Like what?
Rather not get into it since we're still nibbling.
Kidding.
But
I tried. I was trying to get you a headline.
Am I on?
If you look at one of the interesting things is a lot of these deals either repriced or went private in, call it 21 or 22. And as a result, their 28, their first lien's due in 28.
Or the
So
Alameda ones in 2032.
yeah. So, but because of that, they're kind of in the period where it's kind of hard to LME with, call it, less than 24 months to go. And so it's, it's kind of the maturity wall is kind of interesting in that industry. I think that it's eclectic of what we're looking for. But, clearly you rather, I think in general in stressed investing, I always take the easy route. Whatever has good growth, a nice spread, and seems like it has a tailwind. I always prefer that, and you're able to get some of those types of companies with mid-teens yields. So that's there are some chuglies out there that are trade at big discounts, and the creates are less than 3 times, but they also come with risk.
Of course, a very quick follow-up. Do you pay more attention to the sponsors now within this too? I know there are some sponsors that play bigger roles in software, but has it become more important who owns a company and who might be willing to actually maybe provide equity down the line or some kind of help?
I'm going to, of course, the sponsor always comes into play. One of the things, and we have owned companies as well as investing in companies, and I have a greater appreciation since we've been in business for the quality of the quarterback. So that's certainly something that we would give more value to as management than to other sponsor. That's something that would be our first issue that we'd be looking at.
I think we have one here.
I thought it was interesting that you guys bought into the Saks DIP loan. Kudos to you.
I think.
I'm sorry?
I said we think.
Yeah, it looks like a real estate play. Given that there's an enormous number of real estate filings, predominantly in the Eastern District of New York, are you seeing a lot of real estate opportunities out there?
So I think of on Saks we are restricted. So I probably we do overall like the investment, but I just rather think that the existing team or the team that's been reinstalled is doing a real nice job. But I'd rather leave it there because we are restricted. In terms of real estate, I think that from a Darwinian standpoint, you always have retailers that go in and out of business. In terms of the type of real estate transactions, we haven't seen, I would say, distressed real estate that's from a volume standpoint that's any different than the last few years. I would say it's we're seeing some good opportunities in real estate, but frankly, it's more performing than in distressed. If there's something anything specific that maybe I could respond to on the filings that you've seen.
No, there's just a lot of real estate filings where there's too much debt. And there was just a large filing in Delaware having to do with a Chicago hotel. Obviously, if I could own Fifth Avenue real estate like Saks, that's pretty attractive.
I think of that. It is landmarked, and I would think that's going to be part of the operating. The conversion of department stores to other uses like real estate, et cetera, or to more smaller box real estate, I think is a very is a good strategy, and I think there's been good success with that. So I think the alternative use strategy is a real strategy. A lot of the department stores that were sold from the Neiman's, Saks, historically, I think have been good investments for the buyers.
Ed?
So I would agree with you about the equity markets being a fairly good indicator of the real economy. believe that the high yield market, bond market, was an excellent predictor of recessions in terms of default rates rising 1 to 2 years before a recession. But that's not the case recently, as you know, with extremely low default rates for high yield bonds due to COVID financing. And as one of the prior speakers said, a lot of the high yield market is now double Bs.
That's actually a more important quality, that the below double B has found other outlets like private credit.
Exactly. So I think we need to look for other credit indicators than high yield bonds, because this is a very unusual period for high yield bonds, given a lot of it was financed during COVID at extremely low interest rates and as fixed rate. So I look at broadly syndicated bank loans, and even more important, what we would call shadow default rates in the private credit. You mentioned PICs. So what's more important besides PICs is the percentage of PICs that are exercised. And that is going way up,
Yep.
in our opinion. So as a leading indicator, we may look at that as well as the broadly syndicated loan market to get some clues about the real economy. At least I'd like your opinion on that.
Sure. So I think the straight down the fairway reaction is just looking at bank loans. So one of the things that we used to think of bank loans as senior in the structure and as less risky than bonds. It's actually flipped. So bank debt, and this goes to, I talked about a theme of issuers or investors who become in the manufacturing business. And the largest issuer of, or the largest buyer of bank debt are CLOs. And CLOs basically look to have a diversified portfolio and then reload. And as a result, the bank loan is riskier, has more single Bs than the bond indices. And so that's the better, is I think the better metric to look for, early detection. It's also been somewhat technically driven, so I think can be a little late, which from a trading standpoint is also a good thing.
We have a question over this side. You want to get a mic, Matt, over here in the middle?
They're passing it around.
I recognize it's probably like a smaller part of your book, but given where, and you did just say you kind of like the more growthy stuff with tailwinds, but kind of given how flat the term structure is and where spreads are, like how do you view the shorting opportunity set?
It's been a tougher market to short. I think probably seeing some of the issues in some of these private funds, has been maybe the obvious one that's worked and is out there. But I think that when I look at some of the names and where I thought they would have been relative to what they the announced earnings and where they've been, it's been somewhat technically driven. You also have the LMEs have kind of the in-group and the out-group. And that's also been kind of an interesting theme to be shorting. Because if you're not in the in-group, then your recovery can go down materially. So that's another kind of theme that's been an interesting theme. But in general, I found this a trickier 12 months to short than in other environments. But there have been a couple of themes that have worked, like as I mentioned, those involved in private credit and those managers. It's something that you could see. It's just likely to be better or worse, and it's more challenging. Was a few months ago. I always say when you begin to see things in the paper every day, it becomes more even weighted about what's going to happen. We've certainly seen that the last few weeks.
Why don't we take one last question? Matt, do you want to bring it up to Josh here?
Thanks, Steve. I think it was on Dan's site. Somebody posted, we don't have a default problem in the leverage loan market. We have a recovery problem. I thought it was really interesting that I think it was 38 cents now, and the high yield bond recovery is 40. Your average high yield bond recovery is 40 cents. You now have what you mentioned, like the loans are actually more risky than the high yield bond, because high yield bond issuers tend to be larger. There's more public companies in the high yield bond issuer, whereas we know that the loans are mostly private equity driven. It's all first lien. 80% first lien, 20% equity structures. What do you think that says about some of these businesses are good, some of these bad, but the recoveries are now so far. The average loan recovery, I think, was 70 or 80 cents, right? Pre-09.
So
60% had.
So can I ask you a question? If somebody said you have worse ratings on door number 1, and you have better ratings in door number 2, what do you think the recoveries are going to be? You would kind of, broadly, they have a long record of directionally getting it right. You would think the door number 1 with worse ratings would have lower recoveries, and that's just what's happening. So I would think it's pretty predictable and not surprising at all. In fact, we were kind of in a lot of our slides, probably even at Milken that are public, have been saying this for years, that we would expect it to crisscross, which is what's happened.
Is now a good time to get into the credit industry?
I love it, and absolutely. If this is your passion, there's going to be different ways to express it. It's deep. So I very much recommend the credit industry if it's if you find the types of investments or the types of different subsectors interesting. And it's always evolving. So what is being used for senior notes when I first started became second lien debt. Then there were whole companies, because they were cheaper to structure, like IHOP and Applebee's in the structured finance market. Then there was private credit, and who knows what the next shiny toy of innovation is going to be.
You should know that. What is it?
You know what? I'm working on it.
Okay, maybe you'll tell us next year if Dan has us back. But thank you, Steve, for the candor, for spending the time, talking through everything.
So,
thank you.